It's showtime.
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 It's
I couldn't help myself. It's our last class. I wanted to have some fun. Live from sunny Southern California. It's the year in the making real life trading futures classes. I'm a little bit sad tonight. This marks the conclusion of this series of webinars. It's been a lot of work, but a lot of fun too. Hopefully each of you has found something of value that you can incorporate into your trading. My name is Caryn. I'm here to help you, not just in futures, but in all the markets you trade. Tonight, we're going to explore the world of currency futures. Please note, this is not Forex, although the two are sort of related. Currency futures are traded through an exchange. They're regulated. Payment is guaranteed to you by the exchange. Forex, not the case, at least not yet. Now, certain commodities, type in a 1 if you guys can hear me. Just somebody. Awesome. Okay, thanks, Chris. Moving on. Certain commodities and financials of factor interrelate with the currencies. So we'll also cover those unofficial currencies, interest rates, treasury bonds, gold, crude oil, because they share special relationships with particular currencies and with each other. One goes up, the other goes down, some go up and down together, and some more than others due to the economic structure of that country. So when trading currency, it's important to maintain an awareness of how the other currencies are behaving, at least the important ones, and those unofficial currencies I just mentioned. Some are directly correlated to their respective countries' economies. One of the simplest examples is the Canadian dollar, which we fondly refer to as the loonie. No offense, guys. It tends to move with oil because Canada is a major exporter of crude. So if the price of oil goes up, the Canadian loonie tends to rise. And when the price of crude falls, the loonie tends to fall. For me, there's no better confirmation of a trade than when it's confirmed by a cross-market relationship. We'll get into that and a heck of a lot more. But first, this word from the legal department. Trading is risky. Never risk money you can't afford to never see again. Because no one clicks your mouse but you. Click responsibly with full knowledge and personal accountability. Each decision to click that mouse is yours and yours alone. So let's jump on in. Currencies, there's a lot of them. In my opinion, not all of them are liquid enough for day trading or even worth bothering with. I kind of tend to focus on 6. You can see I forgot to grab the pen. Oh, one thing I just haven't gotten right. These are the 6 I focus on right here. Not my night. Okay. Occasionally, one of these others jumps into the spotlight, the ruble, the peso, and I'll trade those too. But these 6 with the ticker symbols, those are the ones I focus on. Next slide, please. Okay. Here's the contract specifications for the 6 majors. That's how I refer to them. They trade on the same quarterly schedule as the indexes, expiring March, June, September, and December. Now, currencies are a little funny, right? Because they are cash settled, but can you touch a dollar or a euro or a pound? Can you touch a dollar bill? Yeah, of course you can, right? Yeah, so what do we know about commodities that we can touch? Do they settle in cash or do they settle in stuff? Stuff, yeah, exactly. Very good, you guys, stuff. So the currencies are cash settled. What makes it stuff? Well, I'll just tell you, the cash that you get is the currency you're trading. So if you're trading the euro and you hold into expiration The contract will settle in cash, but the cash will be euro dollars. So it gets a little funky. Settlement is made in cash, so there's no first notice day. But at expiration, settlement is made in the same currency as the contract. So again, just close the position a couple days before the last trading day. And there's some other funky stuff involved with currencies too. Thankfully, the months, like always, remain the same no matter what you're trading. F is always January, X is always November. But if you take a look at the contract specs on some of these, is expiration the last day to trade these contracts? I mean, look at this. Prior to the last trading day, you've got to arrange with a bank to have the money. Holy moly. And how much prior? Is it 2 days? Is it 3 days? Be careful out there. What's cardinal rule number 1? Nobody remembers? Bright red letters. Yes, thank you, Daniel. Know your instrument. Fred, nice. I like that. Very good, you guys. We're smart traders, so we definitely want to be flat by at least 2 days before the last trading day. If we like the trade, you can always get into the next quarter's contract. Okay, awesome. Yes, David, I'm a strong believer in trading the currencies rather than Forex. We talked about that in one of the round 1 classes, and I highly recommend you review on YouTube. Okay, so now remember how we looked at the sector weightings of these indexes, and we saw that although the indexes are, fairly broad-based instruments sector-wise, right? We've got industrials and materials, technology, healthcare, consumer, whatever. Differing sectors have different weightings in each index, so that if all things are equal, each economic report would impact each index in relationship with its sector weighting. So depending on the sector weighting of the index, price action, may occasionally correlate or inversely correlate with a commodity that is crucial to a particular sector. And an index with heavy exposure to that sector would most likely be affected more than an index with lighter or no exposure to that sector. I think we use the example of the petrol complex inventory reports, right? Crude oil, natural gas, not affecting the NASDAQ at all. Well, guess what? There is a similar relationship between a country's economy and that country's currency. Each country has its economic strengths and weaknesses. Some are rich in natural resources, right? The hard commodities, things that are drilled or mined. Some have fertile land and produce agricultural surplus, right? They come up with a lot of the softs, things that are grown or raised. And some countries have a lot of people and can offer an abundance of manufacturing or skilled labor. I wish I could have found a map like this that was a little more modern. This is some of this is outdated, but but you get the idea. Most countries have some form of exportable abundance, surpluses that it can export in exchange for foreign currency, which can be used to import commodities and products that are insufficient within that country to meet the needs of the country's businesses and citizens. So when a country has a perceived dependence on a particular commodity as an import or an export, that country's currency might be influenced by that particular commodity's price fluctuations. In other words, there's a relationship between that commodity and the currency, kind of like, NASDAQ and tech, right? Something happens in tech, NASDAQ's going to get hurt. Something good happens, it's going to pop. It's like that. Hopefully that made some sense, but I'll give it one more go just in case. Most countries have some form of exportable abundance, surpluses that it can export in exchange for foreign currency, which is used to import goods or services the nation doesn't have enough of. Now, there are a few countries whose economies depend very heavily on a particular commodity as an import or export, and that affects their currency. So we call that a cross-market relationship between the commodity and the currency. Some folks even dare to call it correlation. Now, not all correlations are created equal. Some are ever present, they're strong and persistent, and others can be coincidental, kind of occasional, maybe seasonal, which is why one clever fellow figured out how to mathematically quantify correlation. It's called the Pearson Product Moment Correlation Coefficient Scale. Try to say that 3 times fast. It's a mathematical formula that spits out a number to help us regular folks understand the strength of an association. Let's see. So we have positive correlation. Where's my mouse? Positive correlation right here. When they move together, see, they're both going up, both going up. That's positive. This here, negative, just like divergence. Anyway, this should be familiar to you. It's just like divergence. Now, the degree and kind of correlation is measured on this Pearson scale here. And the way you read it is -1 is the strongest inverse or negative correlation. That would be this one here. +1. And of course, it's opposite to the chart I put on. Sorry, guys. +1 is the strongest positive correlation. And the closer the number is to 0, the weaker the correlation is. So, moving on. Correlation and inverse correlation are especially evident in the currencies because they all trade against each other. One currency can't move without affecting all the others. So as one rises, the others kind of go down in relation to it. And that's just the nature of the global market. It's like, what's that movie? There Can Only Be One. Anyway, like a horse race that never ends. The big 6 are constantly jockeying for position. Highlander, that's it. There can be only one, or something like that. Anyway, sometimes the dollar leads, sometimes the euro leads, and when a new currency takes the lead, the previous leader falls back, and they all trade against each other. So as one garners strength, the other must soften. Because of this, the major currencies are kind of permanently range-bound. Each can only go so high or so low in relation to the other majors. So pretty much any time one of those big 6 hits an extreme level, the odds are in your favor that once that initial shock of news calms down, it will rebound from that extreme. And because the other major currencies cannot devalue past the point where people can no longer afford basic needs like food, water, electricity. I mean, that's how governments fall and wars begin. Where am I? Okay, so this is a chart, and this is a 7-year sample period. Now, you know, it ended September of last year, but that's a pretty good chunk of data. So these are fairly long-term studies, and they reveal some of the strongest, most consistent correlations between commodities and currencies. So let's see. Let's just see if we have a sense of this. Knowing what we do so far, the closer to 0, weaker the correlation. Closer to positive or -1, stronger the correlation. Which is the stronger of these two correlations? Let's see. Let's go with copper. Come here. Copper to the Australian dollar, or orange juice to the Japanese yen. Which one's stronger? Chris Avery, very good. Yes, the copper Australian dollar is a stronger correlation than the yen to orange juice because this is closer to 0, this is closer to 1. It doesn't matter if it's a red negative number or a black positive number. It's about how close or how far it is from 0. So let's try one more. Let's look at crude oil. I bet a lot of you are trading crude oil. which has the stronger relationship? Crude oil to the ruble, or let's see, crude oil to the Canadian dollar? Which of those two is the stronger correlation? Very good, you guys. Yes, the Canadian dollar. This one's stronger. It's closer to +1 than the ruble. All right. Awesome, you guys. So correlations are stronger when that commodity is trending, and they're weaker when the commodities or the currency is just in balance. Now, when a correlation starts to break down, it's often a signal. It's like a little warning sign, kind of like the skew we talked about the other day. It's a warning that the trend is coming to a pausing point. It may even reverse, or it might create a new balance area. I'll show you what I mean. Okay. So leading up to this gray rectangle, we've got, let's see, red is the Canadian. So here's the loonie. There's the loonie, nice uptrend. Here's crude oil, nice uptrend. And they're moving together until right here. Crude is still going up, but the loonie is falling. That's a broken correlation. And it's a sign something changes in the wind, not necessarily today or tomorrow. And you can see, I mean, they were disconnected for quite a while. And that's at least 7-8 months. So it's not going to happen tomorrow. So don't think it's an actionable thing. It's more of a, okay, something's wrong here. I'm not sure what's going to happen next. I'll just watch and wait for the right opportunity, because we don't know. I mean, we know now what happened. The crude came a tumbling, but at the time, we had no idea what would go down. It could have been that instead of going on this rampage downward, the loonie could have come up and caught up with oil. You don't know which it's going to be. So be careful. When correlations that are normally there break, it's time to step aside and see, let things settle down. Let's dive a little deeper into crude. Despite all the efforts to rely more on renewables, after food, water, and fire, oil is still one of the world's most basic necessities. Every day, the world consumes about 93 million barrels of oil. And so today, the world consumed about $5 billion worth of oil. Oil and its distillates are the economic backbone of every first world country. And oil prices, as you may have noticed, are pretty volatile. They can make some big swings that can help or harm the heavy importers and exporters of oil. So when oil prices are high, the oil exporting countries prosper. But they suffer when the price is low. It generates less revenue, creates budget shortfalls. They have to cut services. They suffer with things like uncontrolled inflation. It's still a problem in Venezuela, but last year the inflation rate in Venezuela clocked in over 270%. That's just nosebleed high. To give you some perspective on just how high that is, the ECB and the FOMC have been struggling for years now to coax the Eurozone and U.S. inflation over the 2% mark. 2%. Venezuela, 270%. That's huge. And there's riots in that country. People can't buy food. Anyway, it's the opposite for the net crude oil importers. Lower oil prices reduce transportation and industrial production costs. They raise revenue, the currency valuation, and of course, higher oil prices damage the oil importing economies because they've got to spend more to get what they need done. So nations that rely heavily on exporting or importing just one or two commodities, their currencies, well, they should have currencies that tend to fluctuate with the price of that commodity. Does that make sense? I mean, I hope so. It should make sense. Okay, great. Glad to hear it. So let's keep going with oil. Hey, let's see if you guys can name the top 5 oil producing nations in the world. I got to warn you, though, this map you're looking at is 5 years old, so don't think there's any big hints there. Saudi Arabia, very good. I would agree with that one. Russia, very good, Daniel. I see Chuck's on the same page. Nice to see you tonight, Chuck. Canada, very good. U.S. Okay, I don't know if anyone's going to get the... Oh, Venezuela, that's a good try. Let's move on. Greece. Thank you. That made me laugh. So, believe it or not, China, one of the top 5. Great work, you guys. And, you know, this is 3 years ago. Things have probably changed, but not much. Now, is anybody surprised to see the U.S. producing very close to as much oil as Russia and Saudi Arabia? I was. I mean, it surprised me. So, looking at these 5 countries, which of these currencies do you think has the highest correlation to the price of oil? No surprise. The highest correlation, the currency to the price of oil. All right, Russia's a pretty good guess. It's up there. Let's take a look, shall we? Knowing which currency and the nature of its correlation with a particular commodity helps you know which scheduled news events, remember those, might create opportunities in the currency, or at least when to close or tighten your stops and protect your positions. Now, we have a couple of very strong correlations here. Just so happens to be the Canadian dollar. And the last time I looked, Canada was the 5th largest oil producer in the world. And I mean, this is a pretty tight correlation. I mean, these are moving. That's, you know, this is a little bit aberrant, but that's a pretty strong correlation. And oil only makes up 16% of Canada's exports. So it's a little surprising to see such a high correlation. But again, I mean, this might be a correlation that breaks down again in the future. For now, it's real. Russian ruble. Now, this is like lockstep. I don't know why that came up. Anyway, I don't trade the ruble. I'm not sure how liquid it is, but talk about correlations. This is like the gold standard because oil accounts for about 63% of Russia's exports. Russia sits on top of the 3rd largest oil reserves in the world, and I believe the #1 natural gas reserves. Now, the U.S. is a big exporter of oil. Why is the dollar, we're over here now, why is the dollar moving in the opposite direction, inversely to the price of crude? And the reason for that is the U.S. economy is more diverse. The U.S. exports agricultural products, machinery, services, minerals, steel. There's more. We don't rely too heavily on any one export or import commodity. So because our economy is more diverse, we're not as affected by the fluctuations in the price of crude. But what about Saudi Arabia over here? Now, this is interesting too, because Saudi Arabia, that is not a diverse economy. They rely very heavily on crude oil exports, almost entirely. So why isn't the Saudi Riyal trading in lockstep with crude like the ruble is and the Canadian dollar? It doesn't make sense, does it? Oh, Daniel Norty, aren't you a smarty pantso? Well, it's a little complicated, but the price of a commodity typically has the largest effect on commodity-dependent countries with floating exchange rates, such as Canada, Norway, Mexico. Meanwhile, countries that have pegged their currency rate to another currency tend to feel the impact of oil price swings elsewhere in their economy, because to maintain the currency peg, those countries have to buy or sell currencies on the open market. Another method that can be used is to enforce a set exchange rate, but by making it illegal to trade currencies at other rates, you often end up with some kind of black market in currency. So as a result, countries with fixed rate policies like Venezuela, Saudi Arabia, Qatar, they have an inverse or sometimes no correlation whatsoever, despite the fact that they depend on a very small world of commodities to support their economy and their currency. And up to the early 70s, this all started in the 70s. There was I'm not going to get into it too far, but when Bretton Woods collapsed, most currencies were fixed or pegged to the US dollar, and the dollar was pegged to gold. But after Bretton Woods exchange collapsed, governments began floating their own currencies. Major currencies such as the US dollar, the Canadian, the Aussie dollar, the yen, the euro, peso, they're floating currencies, and their values change according to how the currency is being traded on the forex markets. Fixed currencies are valuated by being fixed, or they call it pegged, to another currency. Now, to remain competitive in the global marketplace and avoid the impact of the constant fluctuation of a floating currency exchange rate, a lot of the smaller economies choose to peg to a major currency, usually the dollar or the euro. And it's usually whoever they trade with the most. A weaker currency is really good for exports and tourists because everything's cheaper to purchase. But if it's too weak, the buying power of the citizenry gets reduced and people start starving, like what's happening in Venezuela. But even floating currencies have some kind of management. There's the FOMC, the European Central Bank, RBI. These are currency managing bodies. But enough, I'm digressing. Look, the takeaway is the more floating and less hands-on the management of a currency, the more it's going to be affected by the commodity prices of its major imports and exports. Don't panic. This is about to get much easier. Let's take another look at oil. It's just this simple. If the currency is pegged to the dollar or the euro, fluctuations in commodity prices, even if the country is dependent, totally dependent on that commodity, they're not going to affect the country's currency that much. But if it's an unpegged floating currency, it can be heavily impacted by fluctuations in a commodity that the economy is dependent on. Okay, these are the four major currencies that are more subject to commodity fluctuation. Now, the Russian ruble, hugely dependent on oil, very strong positive correlation. The only reason the ruble is not on this list is that I don't trade it. You're more than welcome to. If there's a major swing in oil prices, I'm pretty sure there'll be a major swing in the ruble. So, how does this all happen? Let's start. Well, look, gold and oil are very important worldwide. They're two commodities that have a really strong bond with particular currencies, specifically, right, countries with floating rates that are aggressive exporters or importers, or countries with big mines or oil wells. They're going to be heavily influenced by fluctuations in these commodities if they're not pegged. Oil and gold is associated with a lot of countries in the world, but let's just focus on two major unpegged floating currencies, the Japanese yen and the Australian dollar. Japan is an aggressive exporter. It's got one of the highest industrial production rates in the world. And Australia has very large mines. It exports raw metals and minerals worldwide. So let's start on the left-hand chart. This is the one here with all the blue at the bottom. The blue on the bottom is the price of oil. And here's the price of oil in dollars. On this axis is the correlation coefficient. And let's see, red is the yen, and green is the Australian dollar. If you get confused, I've got a little legend down here. So positive number is positive correlation. That means they move together. Negative number, negative correlation. They move in opposition. Now, looking at the correlation analysis on this chart, it shows that the future prices the futures prices of crude tend to be more correlated to the Australian dollar than to the Japanese yen. Especially if you look, here's the Aussie is this green line. It's almost all up in positive territory, and it's come really close to 1, but it's still pretty ziggy-zaggy. I mean, it falls apart from time to time. But the yen is just a mess. Mostly negative correlation with the occasional rocket up. And this means that the Aussie tends to move with crude, the yen tends to move in opposition. And that kind of makes sense because the yen is often used as a hedging tool against crude plummeting. People buy yen, sell crude. Or when crude's going down, they buy yen for protection. Now, on the right-hand chart, this one over here, this is gold compared to the same instruments, the yen and the Aussie, the legends down here. And you can see that the Aussie, I mean, they're spending a lot more time in positive territory, right? Here's the zero line. Below here is inverse. Up here is positive correlation. And it looks like, for the most part, both of these currencies have a positive correlation with gold that's stronger, more consistent than their correlations with crude. Well, why? Australia, one of the biggest gold producers in the world, and unpegged currency, floating currency. So changes in the price of gold heavily influence the Aussie dollar. And there's a strong relationship with the Japanese yen, not because Japan is a major gold producer, but the yen-gold correlation is a consequence of the fact that gold is often used as a hedging tool, just like the yen. So that was a lot of talk. What did it really give us? Well, let's do the short version. Cool, right? That's some handy stuff to know. It might come in useful. But there's another component to these relationships as well. And that is one that maybe you haven't considered. It's called risk. If there's a high positive correlation between two instruments and you are trading both of them in the same direction, you are essentially making one trade, but you have double the risk. If you've put a full R into both trades, you are essentially putting on double your normal risk into one trade. So if you're shorting crude and buying yen, that's kind of the same trade. If you're buying gold and buying yen, that's kind of the same trade. And if you're right and price action goes your way, hey, awesome. But if you're wrong, both trades will lose and it will be 2R, not 1. Does that make sense? It's like if you were shorting Exxon and shorting Chevron at the same time. It's the same trade. Cool? Yeah, awesome. Thanks, Chris. Okay, so if there are a lot of cross-market relationships, particularly with the floating currencies, Aussie, loonie, yen, peso, ruble, knowing which currency is correlated with what commodity can help you know which currencies might be affected by particular economic reports and help you avoid unknowingly having double the risk on that you intended. Now, Australia is responsible for nearly a third of global iron ore production. 60% of Australia's exports are hard commodities: ores, oil, precious metals, steel, copper, gold, silver are on the rise. The Aussie dollar should be too, and of course, vice versa. Now, there's a little more glossy stuff to it. China accounts for 30% of Australia's exports. That's a pretty big trade partner. So if there's an economic slowdown in China's manufacturing, that could affect the Australian dollar too. And guess what? If it'll also affect the price of the commodities Australia exports: iron, copper, gold. You getting the picture? That interconnectedness of the global economy. Now, the New Zealand dollar. Again, this isn't one I trade, but you can see there's a pretty good correlation there. 25% of New Zealand's exports are dairy products. I don't trade dairy products either, or the New Zealand dollar, but if you like the idea of correlation trading, this is one currency that tends to follow a commodity. And there's another plus to trading butter and cheese. Anybody remember about butter and cheese? What's special about those stuff commodities? Come on, you got, yes, settle in cash. They're not, it's not a deliverable stuff. Butter and cheese settle in cash. It's okay. Good job, you guys. You were listening. Yay. Okay, crude oil, huge building block of the global economy. Everybody uses crude. It makes up about 16% of Canada's exports. Their currency is floating, so the Canadian dollar has a very positive correlation with crude oil. That means all else being equal, the loonie will rise and fall with the price of crude. But please, look, don't get confused. It is crude affecting the loonie. It's not the loonie affecting oil. And Japan, poor Japan, doesn't have any petroleum resources at all. As a result, Japan has to import 100% of its petrol complex needs. And as a heavy importer of oil, the Japanese yen tends to trade inversely to crude oil. It's not the strongest relationship, but you'll see it come and go. Yes, Vinny, I do agree with that. We're almost there. Hang in there, kiddo. Okay, so now correlations can help you make some great trades and keep you out of some bad ones. But it's important to remember that nothing in trading is absolute. We're always trading on probabilities. If X pattern forms, then Y trend usually follows. Correlation is not causation. The dollar strength does not cause oil to go down. Oh, I know why it's not working. Oh my God. PowerPoint, my horrible nemesis. Okay, so the dollar does not cause oil to go up or down. There's a relationship, it's a correlation, but correlation is not the same as causation. I've got some great examples to help explain the concept rather than myself droning and on and on. I laughed my butt off when I saw some of these. First of all, I gotta know, what did this statistician have to be smoking to compare the number of films Nicolas Cage has been in to the number of people who drowned in a swimming pool, and then to go the next step and compare that to the total power generated by nuclear power plants? That cracked me up. But seriously, does anyone in here think the number of films Nick Cage is in affects how much power U.S. nuclear power plants produce? Exactly. Yeah. No, there's absolutely no causation there at all. But the strange thing is they are correlated. I've got a couple more. So the number of civil engineering doctorates awarded correlates with the consumption of mozzarella cheese, which correlates with the number of people who died by becoming tangled in their bed sheets, which just so happens to correlate with the total revenue generated by United States skiing facilities. Do you think civil engineers earning PhDs cause people to eat more mozzarella, which causes people to die in their bed sheet, strangling them, so that ski resorts make more money? Absolutely not. It's the most ridiculous thing I ever heard. Civil engineers earning PhDs does not make ski resorts make more money. So correlation, it's there. Look at them. They're correlated, but one doesn't cause the other. I think I've got one more. Oh, two on one page. Okay. So this I'm sorry. I think you guys get it. Does the number of letters in the winning word of the National Spelling Bee really decide how many people will die from spider bites? No way in God's green earth. Or, oh, this one's just precious. How many chickens are eaten affects how much crude oil the United States imports. This is the essence of this is the essence of correlation does not imply causation. That said, there are some cross-market relationships that are pretty reliable. Let's start with when the market gets spooked and there's a risk-off flight to safety, typically exemplified by a sudden drop in equities and a rise in gold. This is called flight to safety trade. Surest way to recognize it is the indexes will be moving down, utilities, REITs moving up, and gold rising, dollar, yen, bonds rising. Now, dollar, euro, major pair. Why does this work? The dollar euro is a major pair. They cannot rise together. They're the opposite sides of the teeter-totter. If they are both rising, something is very wrong, right? That's a broken correlation. You got to wait to see which one blinks. That's interesting. And it's kind of crucial to point out that just because a relationship exists on average over time, it doesn't mean that it's all the time. This is, for me, this particular flight to safety trade is my bread and butter. I mean, if gold is rising, the indexes are falling, the dollar's going to go down. These are definitely going to go up. These, because the dollar's falling, these are going to go up. Well, not the bonds so much. We're in a special place with the bonds. But the euro, the Japanese yen, the euro's going to go up because the dollar's falling. The yen's going to go up because it's a safety trade, and gold's going up. Now, the bond complex lately has been a little tricky, but we'll get there in a second. Where am I? So, correlation indicators. You want to monitor correlations for cracks. And that's pretty easy to do. You see most trading platforms will let you compare 2, 3, 10, as many symbols as you can squeeze in there and still make sense of it all. There's also websites. When strong divergence occurs, though, and the correlation's getting weak, take a step back, understand that the correlation might be in a period of deterioration, and it's time to back up to the sidelines or take a different trading approach to accommodate whatever's going on in the market. Bonds, historic flight to safety, but it's, like I said, it's a little tricky right now because bonds are also related to the interest rate. And when the yield on bonds, well, gosh, this is so complicated. It gets tricky because of the interest rates and the yield curve. And right now, interest rates are still absurdly low. So just for now, be careful with bonds. I've been finding that the flight to safety trade has not been as aggressive towards bonds as it's been to gold and the yen. And this is why. I don't have time to get into the relationship between interest rates and bonds. I mean, that's like a whole other huge webinar. But if you remember just this, you'll be okay. If interest rates are rising, right, that's the FOMC raising the interest rate, bonds go down. And vice versa. If they're dropping the interest rates, bonds go up. So if you think about it right now, bonds are kind of high. And interest rates are probably going to keep going up. So odds are bonds might just keep going down. So that might be why the safety trade hasn't been going to bonds as much. Okay, So that brings us to FOMC interest rates. We're pretty sure, or at least the market's pretty sure, December they're going to hike interest rates. Here's what will probably happen. The interest rates will go up, the dollar will rise, bonds will go down, and the dollar rising will put downward pressure on inverse instruments to the dollar, like the euro and the Japanese yen and gold, possibly oil too. Now, where am I? The only one that, and this is, I can't quite figure it out, but it's like the British pound is like in its own little world. It doesn't seem to be interrelated or connected with anything. It may be because of the whole Brexit up in the air situation. I don't know. In any case, you got to monitor the correlations for cracks. It's as crucial to know that there's a relationship that's there, but it's also crucial to know when that relationship is breaking down. Currency pairs are worth watching. They're high correlation with a commodity. There will be times when that correlation isn't as strong and it might reverse. It could be highly positively correlated one year and then diverge and become negatively correlated the next, like we saw in that chart of the loonie and crude. So it's important to be aware of when this correlation is strong, when it's shifting. It's easy to do. You can, like as I said, do it on your trading platform, or you can go online. These are some great sites. The one you're looking at right now is the mrci.com. They update this like every day, and you can change the lengths of time. I like them a lot, and I like that most of it's white, and it just highlights the ones that you should really pay attention to. But you can use a correlation indicator on your software. It'll show you real-time correlation between a commodity and a currency pair. And, sometimes you can take advantage of small divergences when really they're mostly highly correlated. But if that divergence persists and the correlation is weakening, step back, understand that the correlation may be in a period of deterioration. Just sit on the sidelines, go trade something else. Like I said, there's a lot of places you can check correlations all over the place. So what do you think? Could it make sense to trade the Canadian dollar when EIA reports the petroleum inventory reports? I think it could. How about the Japanese yen? Could make sense too. That could be like your protection hedge in case you get the direction wrong. What else have we got here? Didn't we just see this? We did. I'm not sure what. I must have clicked something funny. Or how about the dollar or even gold? They all seem to possibly react when oil moves. Now, oil inventory reports, that's every week. Have you been getting flat the dollar, the loonie, the yen, and gold? Or have you been leaving that risk on and trading oil also? Have you unintentionally been doubling your risk? I don't know. Something to be aware of. Anyway, and of course, the correlation is not limited to just currencies and commodities. They have relationships with each other. They all interact with each other as well. You can kind of see, like, here's the pound, right? It's just doing its own thing, always doing its own thing. There's our safeties, oil, metals, oil. I don't know how old this is, but again, here's your correlations between the currencies. Anyway, they all interact with each other. They interact with the indexes. Let's see. Geez. Wow, we're just about out of time. And I don't know if you guys are interested, but I've gotten a lot of requests to take a look at today's trading, the price action in the ES today. There's nothing to discuss with this slide anyway. I just wanted to share the ticker info on those other instruments, give you guys a chance to get a screenshot of this. If you're interested in a quick review of the price action on the ES today, just hang out for the questions and answers session after class. We'll do it then. Wow. So cross-market analysis. In the current global economy, financial markets throughout the world are intertwined. I don't care how nationalist, except for North Korea, we're all connected to each other. And even North Korea to an extent, because otherwise all those sanctions wouldn't be effective. And I'm not going to get into that any further, but it's helpful to stay aware of how other markets have performed prior to our market opening, because there's a complex interplay of world markets. Influence, what happens in Asia affects Europe. What happens in Europe affects the US, not just the stock markets, but the economies. Our economies are interdependent. So it's really helpful to stay aware. The cross-market influences are constantly shifting between domestic forces and global forces. News events have their impact, and every once in a while there's something just devastating to the market, and it could happen in Asia, or it could happen in Europe, or it could happen here. As an investor or trader, it's important to stay informed of global and domestic news, and to just have an exit plan. I'm not saying use the news to trade, but in a way, when you're trading futures, you are using the news, the macro news, the global health of the health of the global economy. That's what you're trading when you're trading futures. So it's important to keep an eye on the key markets, the volatility, the currencies, the bonds, the futures. Each one affects each other. It's like that 6 degrees of separation thing. I want to thank you all for the opportunity to share all of this information with you. And I sincerely hope that each of you found some value in these classes, regardless of whatever level you are in your trading. I want to extend my heartiest congratulations to all of you who have made it from the start to the finish. Today is graduation day. You now know more than the average bear, and probably more than a lot of other traders out there. May your profits be large and your losses small. Live long and prosper. Why don't we take just a couple minutes, stretch your legs, go potty or whatever. I'm going to stop the recording. Actually, I think I'll leave the recording going just in case Jeremy's interested. But for all of those of you interested in having my Sierra chart book, let me give you my address one more time. Just shoot me an email and I'll connect you with the guy who put them together. I did work out a special deal for the people in this class, but I'm not allowed to say it out loud or print it in any way because he doesn't want other people he's dealt with getting upset. But for those of you who do end up going with Sierra charts and those particular Sierra charts and you get them authorized through him, I thought it might be nice just to put a class together, just those of us using those same charts, and look at all the charts in the book, what they do, the studies, the different settings for different instruments and stuff like that. Anyway, quick break. And yes, they do work for, they do work for all the instruments. So just give me a couple minutes. I'll be back. We'll take a look at today's trading too. Okay, I'm back. Can you hear me? I'm guessing you can. So let's just close PowerPoint. Hang on here. Shut down the slideshow. I don't want to save that. So much stuff. One computer. Bye-bye. Oh, just forget it. All right, that's easier. So I okay. So let's see. Yeah, well, a couple of days ago, Tuesday, as a matter of fact, I mentioned that the skew had gotten to the point where it was ready to pop. And I said probably 24 to 36 hours, we're going to see a pretty good, decent sized pullback. And sure enough, that's what happened. And it happened in the overnight, or at least it began in the overnight. Sadly, I was working on this class. I saw it happen and watched it go. But here it is. You can see it broke down last night about, well, it didn't really break down until it got below this weekly resistance at 59. And then once it broke this, it was good night. It tore right through the previous value area and went down, 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 down. And let's see, what time did the market, let's bring this over to, let's look at the daily. And it was really just textbook how it traded. Let me bring the daily in. Or actually, what I should do is bring in the weekly. Well, you know what? Let's do it the way we always do it. Here's the monthly. This is the drop right here. And you can see it went right through the value area high. That was the first sign it was going to happen. My purple supermarket power cave. This is the overnight. Came down through the value area high. Then it came all the way down. It just blew through the volume point of control, blew through the, well, it didn't blow through this. I mean, this is the monthly, but it almost came down to the value area low. Now, I did have a buy sitting down here at this level with a stop below this single print here on the monthly. Didn't get a fill, but, you know, it's not over. And there's always another bus. So now the weekly, and oops, that's not the weekly. The weekly. This is what I was using to inform my trades the most. And you can see here's the value area high from yesterday. This highlighted blue area. And here's the day before's trade, very tight range. And we've had a heck of a lot of them in a row, which is also a big hint that the market's getting ready to do something big. I mean, look at how tight this trading range has been. You know, what is this, like 5 points, 5 points, 5 points for, well, let's see, you know, 1, 2, 3, 4, 5, 6 or 7 days. Fred, that is awesome. I am so happy for you. Congratulations. Well done, son. Yeah, this is weeks, isn't it? Thank you, Catherine. Yeah, we've been in a really tight range for a while now. So yesterday's trade, I was looking to get short, but I didn't want to do it at the end of the day from down here. I wanted to do it from up here. Didn't happen for me. Okay, so the first sign that it was coming was we broke through the value area low. We did recover it and return to this. Can you see my little cursor? I'm hoping you can see this thing moving around, the purple lines. And so it broke down from value. Actually, the whole day, this whole day, not today, but yesterday, was textbook priming for the price action, right? We opened at a new high, traded down, didn't quite make it to the point of control from the previous day, although, it's debatable where that really is. Came back, made it back into the current developing value area, made it to the point of control, made it to the value area high, stuck a little head out the top, got rejected, right? Remember, we test both sides before a real move comes. I don't know if you guys remember that. I was talking about that from way back in the beginning classes on volume profile. We test below, we test above, then the move will happen. Everybody has to get stopped out first, okay? So then, towards the end of the day, people started getting out, maybe even actively shorting, and we came back to the TPO point of control, the developing one, went through the volume profile developing point of control, broke below the value area, and then all these people who shorted in those last half hour of the day had to buy to close. Now, we traded in this range most of the night until pretty late on. Let's see, here's, now this is a 24 hour, so this includes yesterday's trade, right? Here's D right here. You see it? Let's see if I can split it there. There. Okay, so this is the beginning of the trading of today's trade, or excuse me, last night's trade. No, I'm wrong. It's 24 hours. This is yesterday after hours. This is the day before yesterday's after hours. This is yesterday's trade, and this, from here on, did I get it? I did, okay, is the overnight, last night. And then this, let me split it up one more time, is today. Now I can't see my split. There we go. Okay. Perfecto. I should have done that sooner. Sorry, guys. Okay, so this is the overnight. You can see where the breakdown initiated at this weekly resistance. And by the way, this is something that comes with the charts. His name is Jan. He's a nice guy. Jan put this on the charts for me. So we broke this weekly resistance level to the downside, and then we sort of hung out in this 57, this area for a while, because I think there were a lot of people looking at this. They saw the head and shoulders. Let me bring it down a little bit lower so you can see it. They saw this kind of funky head and shoulders shape, and they thought, well, it'll bounce from here, or it'll bounce off the previous value area high like it's been doing forever. Those are people who weren't looking at the skew. If you had seen the skew, you would pretty much have known once it broke 59, or, it for sure, once it broke 57, it was, pew, 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 game over. And sure enough, it fell like a rock. So this is the weekly. Yeah. Let me just tighten things up a little. Now, once it got through here, everything we've learned came into play. When it's falling like this, don't jump in front of that. Don't try and say, oh, it's going to bounce. It's going to bounce. If it's doing something like this, don't even try to buy it until it's moved at least 15, 20 points. There's just don't even try. What I do like about where it came to is this weekly support. It stopped right around the first weekly support. And this is the Globex, isn't it? Get out of my way. Yeah, this is the 24-hour daily chart. If you look on the weekly, it's really obvious, which is why I like to have these charts too, right? A lot cleaner. When you're dealing with big moves, this makes it much, much easier to see where price might go. And you can see that this 49 level, a lot of people bought here because, well, look at it. We've got 2 points of control. They're both virginal. Nobody, and then we had some buying down here too. But this weekly support turned out to be the magic place. And quite frankly, it went straight down there first. I think once it broke all of this. Look at it. P. Yeah. Yeah, it did. It just went straight down. But then it recovered a little, right? And you know how I talk about don't freak out if you don't catch the very first entry, because it almost always comes back. Look how close it came to coming back. Not just once, but twice. You could have got it in here. You could have got, if you missed all of this down here, you still could have gotten in once it was like steadily above this pivot. That's along. And where did the thing trade to, guys? Did anybody notice that? We talked about this Tuesday, right? First place that it was going to pause, value area low. There it is, value area low. Second place, it was probably going to pause, one of these points of control. It paused at both. Kept going up from there. And where did it go? I'll show you. It went to, went right to the value area we had just traded down from. And it paused at the underneath that value area. Then it traded to the POC. Then it traded to the top, tested above. Right now, I'll show you what I'm thinking looking at this. And a lot depends on, there's a lot of what ifs out there with all the earnings reports, and there's some more economic data coming out. But looking at this, what I think is most likely is that we're going to trade. Let me get a horizontal line. We're going to do some sideways trading. Not for sure, but I'm guessing probably. Oh, come on. Between these two lines. Oh, let me put another one. Between these two lines, mostly for at least, till we have, I still have the, sorry, until we have some symmetry with this area here. Now, it could be that because of earnings or, something happening somewhere in the world, instead of actually building this symmetry, it could just rocket right up, or it could fall right back over. It's not looking terribly strong at the moment, but this market has been so resilient. Skew is still pretty high. Tonight it's at 146. So it may be there's a little more downside. If I was looking really hard to get long, I kind of like this level here, the top of this value area on the weekly. Maybe the Deepak 54.75 looks good. It might even make it down to this 52.50 level. When you look at the pattern that's formed on the weekly, I mean, that's pretty much an inverse head and shoulders. Anybody disagree? Yes, all the support levels auto plot on the charts. Yeah, very good, Fred. Yeah, all of this stuff is automatic. It does sort of look like an inverse head and shoulders. My only reservation about it is, an inverse head and shoulders is not a top pattern, it's a bottom pattern. So it is possible that if this trades sideways very much, we may actually go down from there rather than up. I think we'll know for sure within a week or two. But, we've also got the whole Santa Claus thing coming. Who knows? Yeah, I mean, it's a bottom, even though it's a top too. I'm torn on it. It could just go parabolic again. And then we would be looking for our measured move, right? So we would go from the bottom of this to, from here, we'll call this the neckline. Uh, ba, ba, ba. So, the 150 would be halfway there. Let me put some prices on this. There it is. Okay, so 2571-ish would be our first target, and our second target, which would be the measured move of this weekly chart, it would not happen in one day, I don't think, would be 2581.75 or somewhere around there, and that just so happens to coincide with weekly resistance 3. It'll probably match up with something on the monthly. Anyway, that's my analysis of what happened today. Now, there's another interesting thing, if you guys aren't too bored yet. On these charts, one of the nice things that we have is it gives you this cumulative column. Oops, I'm still drawing. Anyway, you can see my goodie. Here, we'll make the hand. So you can see this column here, for as long as my chart has been open, it has kept track of all the prices that have traded and how many contracts were bought. How many contracts were sold at the bid. That's this. It's not the hand. That's this column on the left, right here, this one all in red. And how many were bought at the ask. That's this green column here. And if you look, you can see there's these areas with the rectangles around them. These are areas where there was a lot of trade, and they tend to act as places that big money will defend. So I would be very surprised, frankly, if price even gets below, what is this 5650 level, just because there's so much, really a lot here. And again, you see a huge amount of buying at the 52 something level. And those are exactly the levels we talked about. So yeah, and so that's my analysis of what happened today. It was really, it traded just right according to the textbook. Does anybody have any other questions? I'll stop droning and answer anything you might want to know. Yeah, they are cool charts. I'll tell you that. I mean, and there's this. Here, I'll show you one that here's there's the yen. I've got it for the Russell and Q. It works with everybody. I've have it spread out over several screens, so it's a little congested. But I even use it on bonds. They're awesome. Sketch. Yes, of course. Any pattern that you see on a TPO chart or on an internal market indicator, those are all valid patterns. And if it fails on a market internal, it's going to fail on the chart. I promise you. If it fails on the TPO, it's going to fail in price. All these things are kind of an early warning. Like if you see a head and shoulders on the advanced decline or on the VOLD, and the ADD or the VOLD breaks that neckline, then yes, price is going to go through. It is not going to hold. At least 90% of the time, that's what's going to happen. The TPO stands for time, price, opportunity. It's a convoluted name. It's all created by Peter Stettlemeier, who was a very smart cookie, but sometimes those people who are incredibly wicked smart and good with math and stuff like that, their linguistic skills are a little less, I don't know, not as able to communicate as well to regular folks like us. Can I do a quick sketch with your draw tool? Absolutely. Let's go back to ES and let me find that. It was the weekly chart, yeah? No, not that one, the other weekly. Monthly. Yeah, there's a lot of charts in here, and I can't tell you how grateful I am to this guy that I mean, you could also call it a double bottom, a multi-bottom, but let me get something to draw with. Let's do, I've got the wrong bloopy. Here we go. So, does that help? I don't trade through Sierra. I trade through AMP. So I don't know what Sierra's commissions are. AMP is incredibly flexible. Just today, I got an email from them saying 15 cents per trip, which is like a crazy low price. Yeah, I think that if a bunch of people end up buying authorizing the use of these charts on Sierra, I think we'll do at least a powwow or some kind, maybe without Jeremy. He said this is okay, by the way. I'm not like jumping anything. But yeah, we'll do something together, maybe via Skype, where we're just all together and I'll share my screens and, tell you what I'm watching and what this means, what that means while it's happening. Can I do 2 classes? Well, that's not a bad idea, BW. I'd consider that, but it depends how many of us there are. If it's just me and a couple people, we could probably do it all in one class. If it's 10 or 20 or 30 people and everyone's going to have questions, then yeah, I think I would do 2 classes. Yeah, Fred, you see it too, right? I mean, it could be a double bottom, it could be a triple bottom, call it whatever you want. Pattern completion is pattern completion. Yeah, exactly. Okay. How do I separate the bell curve mash and make a dual display with the letters separated? I'm not sure I understand what you're asking me, Freddie. Are you talking about why is this one all nice and I can, where's my mouse? Why is this one here all nice and separated and this one's like a bell curve? Is that what you're asking? Yes. Okay. So you right click on it and letters blocks an ohm column, separates it out, put them back if you want. You can squish them all together if you want. It's all, now if you haven't gone to the globals and set that stuff up, it's in here somewhere. Well, I mean, I'll go into it with you guys. If if you buy the charts, we'll go through that like together. And if you don't, then all you have to do is go to the Sierra website. I mean, they've got tons of stuff too. It's just easier when someone just shows you. Okay. Are we looking at trade orders as chart patterns? Yes, actually we are. And I'll show you, let me get to that. Come here, you. I have a hard time with my mouse. It's just, I don't know. Does anybody else with multiple screens have that issue where it's like, so you just can't find the mouse? So if you look at this, now a new J just started. So it's a little harder to show you without actually playing back. But this chart, I mean, I call it the price path because footprint chart is actually trademarked. But this, when these keep going up like this, you'll occasionally get a red one, but unless you get 2 and one of them breaks even lower, you're still in this uptrend. See, like this shows you, okay, it's going to go down. This is a really strong trend indicator. It takes 5 ticks for one of these bars to reverse. So it's to get 2 of them to do it, that's like 10 ticks. This is really strong. And then, these green and red dots show you the different sizes of buy and sell orders, and it draws a line across. So in case there's so much information, you can still see where those orders were put in. Since then, he's changed. These are, if it's a sell order, it'll be red. If it's a buy order, it's a green. I just haven't made the switch yet. But you can see into perpetuity where those big orders came in, which I find is useful because they tend to defend those levels. If there's a huge purchase at, like here, we're probably not going to get back to this level anytime soon. What is that, 50, 75? These guys are going to sit on that till December. Anyway, I mean, there's a lot of cool stuff. I really love this add pull thing is huge for me. There's, what can I tell you? They're cool charts, and it would have taken me forever to put them together for myself. So, like I said, no pressure. If you're interested, it's not a lot of money, especially considering how much time it'll save you. I can't say it on the air. Are there anybody with any other questions, or should we call it a night? Oh, you're welcome, Catherine and Stephen. I've had a lot of help over the years. I've spent a heck of a lot of money. If I can save other people from following the same ugly pathway I took to profitability, I would love to save you from it. I've spent a fortune on classes and indicators, and it's crazy. No, the fee for the software from the guy is just a one-time. Sierra charges a monthly fee, but they all do that. If you're using their platform, you're going to pay a small fee, just like you're going to have to pay for data if you want good data. You're welcome, you guys. Thank you all so much. It's a pleasure to teach you, and we'll see what happens with the charts. Maybe we'll see each other again soon. I'm going to call it a night. Thank you all so much. Oh, you're making me smile. I'm not going to be able to sleep tonight. I'm so happy. All right, you guys, take care. I'm going to call it nighty-night.